This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson IVES Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and it is not just me this morning. We're joined by our fellow associate, Christina Melly. Good morning, Christina.
Good morning.
And why are you on the show? You're on the show because we got some stuff to talk about.
Yeah, we're going to talk about the top 20 tax changes.
The top 20 tax changes, yes. This year we had to go double on that, didn't we?
We did.
Usually we do a top 10 list, and this year we had to expand it to top 20 because there's a whole lot more things to talk about this year.
Certainly is.
And so we're going to get into all of that on the program. Christina has been with our operation for 15, really?
15. Well, going on, this is the 15th year.
Wow. So 15 years. Christina is an IRS enrolled agent. She also, as with all of our team members at the office, we all did an additional certification across the board last year. We all became certified financial fiduciaries. And in this era where you hear a lot about unbiased advice or fee-only advice or this type of advice or that type of cost is somehow purer or truer than other types of advice. At the end of the day, we just took the approach of, well, why don't we just get the latest designation in the industry, which is a certified financial fiduciary. And so all of our team members, including Christina, became one this past year. Tell us a little bit about that process.
Basically, there was a set of training that we had to go through, as well as an examination to take a test to make sure we understood what all of that meant.
I remember the examination was trickier than I thought it was going to be.
It was a little harder than I thought as well, yes.
And so once you become a certified financial fiduciary, basically that means you are committing to the highest ethical standard in the industry. So I think for our listeners, you're going to hear more and more about this credential in the years ahead because there really is just mass confusion in the financial industry and among investors and individuals and retirees. As you hear all these terms and you hear all these things thrown around, and at the end of the day, it's all just labels. But particularly when you start talking about different costs and structures and fee this and fee that, at the end of the day, if someone has gone out and sought the highest standard or the highest designation that they can achieve when it comes to being a fiduciary, certainly that is important, and we're proud to share with you that everybody on our team at Nelson Financial Planning last year went out and got that credential. So that's pretty cool stuff. Before we delve too much into the tax side of things, I just got to highlight this, okay? If you have not been paying attention, okay, you may not have realized that the market through Wednesday, so it's measuring a 10-day period, which would have ended on Wednesday of this past week, had the best 10-day period in nearly a decade. Maybe you missed it. Probably you did because, everybody's gotten fixated on the government shutdown conversation. And if the market's not going down, that means you're not hearing about it. Of course, what that also means is maybe the market's going up. And in fact, maybe the market's going up at a faster pace than what it typically does. And in fact, for the 10-day period that started the day after Christmas through Wednesday, so that 10-day market period, markets are up over 9.5%. That eliminated not all of that loss in the fourth quarter, but certainly cut it in half and then some. So again, it goes back to the conversation we have on a regular basis here on the radio show that it really is about staying invested and not trying to time the market. Matter of fact, we were talking a little bit about this before the show started, Christina, about the statistic that we shared that's the most impressive one, and that was the one. Yeah,
where if you miss the 10 biggest days in the market within a long period of time, you cut your return by about half.
Yeah, it's amazing.
It really is.
And I said to you, when I first saw that statistic, I said that just can't possibly be right. But we've seen that analysis done by a number of different establishments, and my goodness, it really is pretty dramatic. And once again, another example, 9.5% run in a 10-day period at a time. People forget the market can go up just as quickly as it can go down. So hopefully you did not make some snap reaction and miss out on that, because that will have a significant long-term impact on your market. Now, is everything all clear? Of course not. Okay? Of course not. You still got the government shutdown, okay, that's been, percolating along. You've still got the trade issues with China, although they're making some progress on that. But I don't know that they've really gotten to the weighty issues. You've still got a Federal Reserve whose next move is somewhat unpredictable. So it's not like everything has gotten resolved, but some of that stuff has started to get resolved, and it happens very quickly. And so too does the market response. But you may have missed that headline because, of course, that wouldn't make headlines, right? Because that's actually positive news for sure. So, but it is getting into January here, and here in another couple or 3 weeks or so, you should have most of your tax information, which means that you need to start the process of getting organized and preparing for your 2018 taxes. As we were talking about at the top of the show, there's a whole lot of changes this year. What do you think are the three biggest ones that are going to affect, I guess pretty much everybody?
Yeah, I think the three biggest changes would be the lower income tax brackets, about 3% lower on average for most of the levels.
Yeah, so that's going to help out everybody. Doesn't matter whether your income is $10,000 or $10 million.
Right.
Your tax rate went down across the board. Yeah.
Mm-hmm. I would say the higher standard deduction. That one is sort of a double-edged sword. I think for some people who maybe didn't itemize before, it's going to be very helpful. However, if you did itemize, it may or may not help you. It may harm you. Yeah,
and that's where supposedly the time savings will come into play, because you don't have to sit down and figure out all of that stuff.
Certainly from a preparer standpoint,
correct.
We like that.
Yes,
however,
we should be rolling through more returns this year than ever before. But also for the individual, they don't have to sit down and try and remember. Okay, when did I take that trip to Salvation Army?
Exactly.
Okay, where are those medical expenses? Where's the real estate? They don't have to do any of that. And as we've said in previous shows, to determine whether you've got to really do that homework, you really need to kind of look at last year before you kind of get organized for this year's taxes. It would be smart to look at last year's taxes and figure out exactly where you were. If you were a standard deduction last year,
You certainly are not going to itemize this year.
Correct. You're going to be taking the new standard deduction. So we will continue the conversation on this, specifically kind of the big things that will hit everybody. We've talked about one, the new tax rates. We're in the middle of talking about another, so we'll continue that conversation and hit the third item, and then delve into some real meat of some of these changes as we continue in the program this morning. This is Dollars and Cents with Joel Garris, joined by my special guest, Christina Melli, here on the program, Dollars and Cents on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
So, Christina and I were sharing a laugh during the break because, well, as we were saying, Christina's been with us for 15 years. So I remember Christina as Christina Melli, and that is her maiden name, and it always sticks with me. So she is, in fact, not Christina Melli. She hasn't been Christina Melli. She's Christina Lamb. Okay, so my apologies.
No worries. No worries.
But she was actually sharing with me during the break that she was talking with another one of our team members, Garrett, and said, I bet you he's going to call me Christina Melli because he does it half the time now anyway. So my apologies. Holy mackerel! It's one of those things where you were thinking, you know, it's hard to get the brain to switch once you identify somebody as, well, anyway, my apologies. Christina Lamb is here with us this morning on the program, Dollars and Cents. This is Joel Garris of Nelson Financial Planning. And we're talking a lot about taxes. Just started that conversation. We're talking about the three big things that are going to affect really everybody. And, of course, the actual income tax rates, those are across the board going to be affecting all of the every American, regardless of whether they make $10,000 or $10 million. You're going to see a change in those tax rates that will put more money in your pocket. We were shifting gears and started to talk about the next big thing, which is the higher standard deduction. Which, if you're doing your homework, you got to look at last year's tax return, and ultimately, if you got the standard deduction last year, it is unlikely that you're ever going to be itemizing. Go with the standard deduction. So for itemized, you really have to look at your itemized. If you were itemizing last year, what are the thresholds that they should be looking at with these new standard deductions? Okay.
So if you're a single filer, the standard deduction is now going to be $12,000. So you would have had to have more than $12,000 in itemized deductions for it to make a difference for you. And then on the flip side, for joint filers, it's $24,000. So you would have to have more than $24,000 in itemized deductions to make a difference.
So if you were close, it probably makes sense to try and do the homework a little bit. Of course. But if you had 18,000, if you were married and you had 18,000 of itemized deductions, that you're just not going to get there.
Yeah, I mean, you just rationalize it. Did you make more charitable contributions? Probably chances are your mortgage went down a little bit, stuff like that. So you can just figure out how that would play out. Yeah, you're
unlikely that you're going to be, and that's the big change is of the. Under the old tax code, about 30% of all filers actually itemized their deductions, and it's estimated that 70 or 80% of that 30% now will not be itemizing. So really, it's going to be the minority that will continue to itemize. So those are certainly two biggies: the income tax rates and the standard deduction. We got anything else we want? We got top three, if you will.
Well, kind of just to go along with that standard deduction is they're taking out the personal exemptions.
Right. That's significant as well.
Correct. So for, two people in a household, that would be a little over $8,000 and less deductions. And in my household, we have a child, so that's $12,000. That's a pretty significant savings.
Yeah, that would be. Now, supposedly they're supposed to try and make up with that with an expanded child tax credit, but
Correct.
well, you always worry about how that ultimately will play out on the return. Another thing they did too was they really did change not just the standard deduction, but they also dramatically changed what you can do on the itemized deductions even.
Yeah,
So,
I think that's what would be my third item would be the limitation on the state and local real estate taxes, mortgage interest, items like that.
yeah, that's the one that we've certainly heard a lot about. And if you're living in places like New York and New Jersey and Massachusetts,
Have a state return.
yeah,
basically.
The state return, and you've also got high real estate taxes and high state income taxes. You're going to be severely limited on that because that's capped at $10,000 for all of what you can contribute. So, not to say that you can't. Down here in Florida, the typical write-off would have been the sales tax and the real estate taxes, and so we would be subject to the cap of that $10,000. But I think that's going to really hit some of the folks up north much greater with that limitation. There's other stuff, though, that's happening on the itemized deductions. Tell us a little bit more about some of that stuff.
Yeah, there's a limit on the mortgage interest that you can claim. This one I feel is kind of high. Probably doesn't affect most people. But basically, if you have over a $750,000 mortgage, you're limited as to how much you can claim.
Yeah, and I think that's less than 4% of the outstanding mortgages, so it's a pretty small number. There's also some confusion though on this one, and we've gotten some questions at the office even about this, about how the interest on home equity loans is going to play out. Why don't you talk a little bit more about that?
I personally did some research on that just to make sure we were clear on how that would play out. And so as long as the home equity line is used to build or remodel or improve a primary residence or secondary home, you can still count that deduction.
So if you used your home equity line to pay off credit cards or something like that,
no,
that's the part that you can't do. You use it to put a pool in or something like that. You can still do that.
That's correct.
So it really depends upon how you used your the proceeds from your home equity line and where that money went. Now, I mean, here's the question that I would ask is, how in the heck is the IRS going to know that?
That's what I say.
Yeah, I mean, but at the end of the day, those are the rules that you want to be following. On a side note, while we're talking about real estate and homes, and it's amazing to me how many people don't realize this is the rule and has been the rule for 15 years almost, and that's the ability to exclude your gain on the sale of your primary residence of your home. So talk to us a little bit about that.
Yeah, I was actually just speaking with a client the other day about this. Basically, a home is considered your primary residence if you've lived there 2 of the past 5 years. And so if that is the case, when you do sell the home, for single filers, if you make over $250,000 on the home or joint $500,000, you don't have to pay any capital gains on those on that money that was made.
Yeah, up to those numbers. So that's pretty significant. I mean, maybe you bought at the perfect time and have made some money in the appreciation of your primary residence, but to have more than a $500,000 gain, I mean, that's
right.
That's pretty good.
The strategy we were implementing with the client that I was speaking with, they had a personal residence and a rental, and they flip-flopped their homes.
Okay, sure. Great technique.
Yeah, so they were looking at how long do I still have to sell that rental and get the exemption, basically. to benefit them, so they didn't have to pay on the games.
Yeah, that's the interesting thing about that. Living at two out of the last 5 years. You're not. This is not you only get to do this one time. I mean, you can do this as often as every 2 years if you've got your timing perfectly lined up. So it really is a pretty powerful strategy in terms of not having to worry about the capital gain. Now, the one thing, though, that you would have to be careful on, of course, on a rental property is if you're selling it, you still would have to recapture the prior depreciation.
Of course.
So you don't get out from that, but at least the gain from the time you moved in and started treating it as your primary residence, you'd be able to avoid that. So interesting stuff indeed. We'll continue the conversation with Christina Lamb of our office here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning. You're listening to News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. This is Dollars and Cents. I'm your host, Joel Garris. I'm joined with my longtime member of the team at Nelson Financial Planning, Christina Lamb. Here on the program, we're talking some taxes because it is that time of year. You should start to be seeing your tax documents trickling on in and what you need to do in light of all of these tax changes. And then, of course, we also on the program did touch a little bit about the market. If you're wondering why you haven't seen much in the headlines of the market recently, it's because the market's been going up. At least if you look at the 10 days that would have ended on Wednesday of this past week, the 10 days post-Christmas through Wednesday of this past week, that 10-day period wound up being one of the strongest performances of the market in nearly a decade, a 9.5% increase during that period of time. Hope you didn't miss it by getting too distracted with the headlines. I'll tell you, when we talk to people, when the market is showing volatility and we talk to them about the need to stay invested, I am sure many people look at me and say, that's just too easy. That's just too easy. There must be something more. There must be something different. There must be something. Okay? Nope, there isn't. Okay? And guess what that proves? Sometimes the easiest things in life are the hardest things to actually practice. And that can certainly be said for investing. Certainly that's what we've seen out of the market, particularly after the 10 days following Christmas through Wednesday of this past week. Does it mean all the issues have somehow magically disappeared? No, of course not. They're still out there, okay? Market reacted to them on Thursday and Friday. But the reality is that it is far more important to stay consistent. Otherwise, you will simply blow up your investment results over time. And I'm thinking you probably don't want to do that. But boy, it sounds easy. It's hard to do in practice. Back to the tax side of things, we were going through some of the changes, and there's a lot, not just, Christina, on the notion that there is a big standard deduction, but there's also a lot of changes even on the itemized deduction side of things in terms of what you can do. Because there's a bunch of them that have been eliminated that we were talking a little bit about before during the break.
Yeah. So casualty and theft losses are now only deductible due to natural disasters or federally declared disasters, if you would. So hurricane, obviously we're more familiar with that in Florida, but hurricane damage and stuff like that. Whereas before, you could have, for say, been robbed or had other types of damage. Even flooding, personally could have been claimed, but Sure. It's not a federal disaster now, so it would no longer apply. The
real caveat there is it's got to be a federally declared disaster area, and not all areas get that designation. That's often you often see the see counties fighting over that to make sure that they get that designation when something happens, because that obviously gets you more money as a government, and now as a taxpayer, that's going to be even more important. Right. Tell some other things that got that got eliminated on that side of things.
I think one of the bigger ones is the unreimbursed job-related expenses is no longer available. So if you were like a firefighter or a police officer, those are some of the jobs we see use that deduction the most. You can no longer claim like your dry cleaning for your uniforms and, supplies, service, dry cleaning, car washes, cell phones, things like that they used to claim. Yeah,
and the traveling as well that people also would put in there, the mileage and things like that, like traveling salespeople.
Exactly.
Those are big numbers, and all of that. I mean, that's not phased out or limited, or that's just straight
gone.
Yeah. I mean, there's no way that you're going to be able to take those deductions in any way, shape, or form. So that's a pretty significant change. What about medical expenses? They're messing around with that, aren't they?
Yeah. For this year, everybody, it's 7.5% of your adjusted gross income is the threshold before you can start claiming medical expenses. That's going to go up for 2019 to 10%.
Yeah. So they kept it at the 7.5%, but then it's getting increased for 2019. And unfortunately, you stop and think about that. Medical expenses is one of the things that just keeps going up and up and up, and now you don't even get any real tax benefit or less of a tax benefit going forward than what you had. I guess there is one piece of good news if I itemize my deductions. What's that? That the deductions for the limitation, the phase out as your income goes up.
Oh, yes, for higher income people, yes. They're no longer phasing out itemized deductions. So they can claim as much as their little heart desires.
No limit to the itemized deductions, whereby in the past that has certainly been the case where you start to get phased out. No more the case. That's probably about the only thing as I think about with the changes that they've done to the itemized deductions, that in fact actually works to the better, if you will. Everything else has gotten eliminated or limited or changed around pretty dramatically. One word though to our listeners, and we didn't talk about this at the beginning of the program, but all of these changes are only good for a period of time. And so everything that we're talking about now is the law for right now. But then a few years down the road, what year is it? It's
2025 will be the last year. So starting in 2026, the rules could change again.
And at this point,
I'm sure they will.
Right, they will, not only will they change, they'll all revert back to what they were before. So this is only good for, this is good for a limited time only, if you will. Otherwise, the tax code reverts back to what it was. So we'll see if the folks in Washington can get their act together to continue some of this stuff. I suspect that some of the more unpopular ones, particularly that elimination of the unreimbursed employee expenses, that's relatively unpopular. Also pretty unpopular is the limitation of that $10,000 on state and local sales and real estate taxes. So those would be the kinds of things that I would imagine would slip on through. Another big change was on corporate tax rates. Now, we predominantly work with individuals at the office, but talk with us a little bit about kind of some of those changes of the corporate tax rate. There are some ones that might certainly affect individuals as well, particularly the Section 199A deduction. But talk to us a little bit about some of those changes.
One of the biggest changes, I feel, although it doesn't affect necessarily individuals, is the corporate tax rate. And that dropped from 35% to 21%. And basically, this is, I believe, done an effort to keep businesses here in America instead of going to other countries where tax rates are more favorable.
Yeah, I mean, that was a change that I think had to happen, and I think both parties were in agreement on that. It does sort of put our tax rates on sort of similar footing to other countries that have cut corporate tax rates over the course of the past 10 years or so. It was huge for 2018, and you look at corporate earnings in 2018. Certainly, the first couple of quarters, it was over 22%. A lot of that was as a result of the tax rates, and then of course there was that one time,
15.5%,
right, where they repatriated the cash back, and were able to get a special rate on that when they brought that cash on back into the U.S. We will continue the conversation. When we get back, we've got to hit this $199 deduction. Christina and I were talking about it on the elevator ride up, and it's sort of hard to explain on the radio, but we're going to give it a shot. Plus, we got to tell you about the new limits for 2019 for your 401k, your 403b, your simple, your IRA, all that. We got to hit that too. So we'll do that as we get into our last segment of the program here on Dollars and Cents. This is Joel Garris. I'm joined by Christina Lamb here on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. My name is Joel Garris of Nelson Financial Planning. We're joined today by my longtime associate, Christina Lamb of Nelson Financial Planning. Christina is an IRS enrolled agent. You've been that for what, number of years now?
Yeah.
So we're talking about some of the big tax changes for the year that you are about ready to embark on in terms of your tax return. This part of the program, we're going to try and tackle some of the high notes on the corporate deductions, specifically the deduction of up to 20% of income that would apply on all pass-through entities like sole proprietorships, for real estate investors, for LLCs, for S-corps, for all of those pass-through entities. And this is the one we hear a lot about, particularly sole proprietors, folks that are in certain businesses. This is where it starts to get a little convoluted. So, Christina, see if you can kind of walk us through what is it? What is some of these specified service businesses that they're talking about?
So service businesses would be like for us, financial planners,
correct?
Tax accountants. Let's see, any type of consultant, doctor, attorney, artist, or like stage performers, things of that nature.
So those are some of the specific trades where they sort of limit what you can actually write off on this, and depending upon the income. So the first thing you've sort of got to ask when looking at this is, well, am I one of these specified service trades or business? Am I a doctor, a lawyer, a CPA, an accountant, a financial services professional, or not? And so if you go first to that's sort of the first piece in the decision tree, and then the next piece is they really look at income, right?
Correct.
So, and then how does that work out? If my income is below a certain level, what do I get?
Right. So basically, if you're for a single filer, if your taxable income is less than $157,500, or for joint filers $350,000, there is potentially a 20% deduction available to you.
Where you would just be able to write that straight off 20% against that income. Now, that starts to phase out, and then again, if you're in that specified service, trade, or business category, at some point you don't get any of it.
Correct. The phase outs for single filers is $207,500, and for joint filers $415,000.
So a pretty significant chunk of income. So that's the piece of if I'm a doctor or lawyer, or any of that, those specified services. For anybody else, okay, you have to look at how much that person paid out themselves as a W-2. This is where it gets a little bit convoluted, because then you have to look at how much you paid out as a W-2, how much depreciated assets you have. I mean, this is where it gets a little bit funky, to say the least. But at the end of the day, it should potentially be a pretty powerful deduction. And unless your income is quite high, it's certainly worth somebody going through that process to determine, hey, how much of this am I going to be able to exclude? And there's a separate form that you have to do on the tax return in order to do that across the board. But I guess the bottom line is make sure you're using the software program to help with that.
Yeah, I think it's a great opportunity for small business owners, kind of along the lines with the corporate tax cuts. It's really just pushing for businesses to thrive better.
Absolutely, with the hope of that you ultimately increase hiring. Although when unemployment's at a 50-year low, that would be great. But at some point, you start to get to full employment. That's for sure. So that one is really one of those ones where you've got to really kind of work through the numbers on it. We've just kind of tried to hit the highlights of how that plays out. You've got to. Bottom line is it's kind of a 2 or 3 stage decision process. Am I, what type of business am I in is the first question. And then the next question is, okay, well, how much money did I, am I making? And depending upon where you fall on that, then it would very well serve as a deduction against your total income. There's certainly some other ones, some other big tax changes that happened along the way for this year as well. Among them, moving expenses.
No longer available.
No longer available unless you're in the armed services, and then alimony also.
That's a big one.
Yeah.
On either side.
Correct. So you no longer get to take the tax deduction for an alimony payment, but if you receive it, you no longer have to report it as income. The ability to recharacterize, which I'm not never have been a big fan of conversions anyway to a Roth, but you better be careful on this one because what's going on with that?
So basically, if you do recharacterize, you used to be able to go back and undo that, but by October 15th. But that option will no longer be available. So you better make sure if you do decide to recharacterize that is definitely what you want to do. Yeah, if
you're doing that Roth conversion to unwind it, that is not going to be an option anymore. So be very, very careful with that. The estate tax exemption also jumped up pretty good. That one doubled up from 5.5 to almost 11 million. And continues to go up. That's a pretty big number. This notion that you've got to worry about estate tax in America, at least under the current rules, not so much. That is for sure. Another interesting one that I don't know that people know a lot about is this 401k loan stuff. So talk a little bit about that to our listeners.
So basically, if you have a 401k loan with your current employer and you decide to leave the company, you have a while to pay that back. You don't have to do it right away, as was the old rule.
Yeah, because the old rule would say, hey, you got to pay this back. Otherwise, it's treated as a distribution, and that's
taxable
that.
income.
Yep, that's exactly right. The music means we're running out of time, so we got to hit the last item real quick. So 401ks, 403bs, 457s, IRAs, and all that, all of those limits increase. So make sure that you adjust your contributions with your employer or your individual retirement account provider to adjust for that. The 18.5 went to 19,000. If you're over 50, you can still add 6,000 on an IRA. It went from 5,500 up to 6,000. You can add in an extra 1,000. We barely scratched the surface on some of these. If you would like a copy of our top 20 tax changes, it's on the website, www.nelsonfinancialplanning.com. We got to get out of here. This is Joel Garris. Thank you, Christina Lamb, for joining us here on the program. You've been listening to Dollars and Cents News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.